Hello, welcome back to another episode of In the Money, the first live episode of 2023. Happy New Year to all our viewers and to our presenters, of course. I'm Konstantin Vrandopoulos with Fidelity's Trading Strategy Desk. Alongside me, as always, Jessica Inskip, Director of Education and Product at OptionsPlay, and Tony Zhang, Chief Market Strategist at OptionsPlay. Both of them are frequent CNBC contributors. It's great to see you back here with us, guys. Happy New Year.
Happy New Year, Konstantin. Happy to be back.
Yeah, Happy New Year. It's a pleasure to be here.
Awesome. Well, let's talk about the equity markets a little bit. S&P 500 has been quite choppy, but mostly sideways, I would say, in about a 100-point range for the past 3 weeks. We first got into this range on December 16th of 2022 last year. I'm curious what you're watching, what's on your radar, what's coming up on the horizon that might be the catalyst for the next move in the equity markets.
Yeah, so certainly in the short run, we have payroll numbers tomorrow morning that will likely have some impact here overall in the equity markets. But medium term, I think really what investors are paying attention to is the earnings season that's coming up. And I think there's potentially some opportunity for markets to potentially rally between now and roughly the 23rd of January, which is really when earnings season really kicks off with some of the major tech names. You do have some banks reporting prior to that. But a lot of times markets tend to feel quite optimistic going into an earnings season. So I do think that you have an opportunity for markets to potentially rally in the short run. But the bigger picture here is still the fact that from my perspective, the bond markets are still pricing in a fairly dovish Fed in the second half of 2023. But if we look at the Fed minutes from yesterday, we still see the stance from the Fed is still quite hawkish here going, especially into the end of the year. And they're fairly standing firm in their resolve to fight inflation. So I think if the Fed continues to stand firm in that and remains this more hawkish view relative to what the market is pricing in, that aligns with our more bearish, bigger picture view in Q1. Which also, if you look at the technical picture, the S&P 500 has been trading in this downtrend since the beginning of 2020. From my perspective, not much is going to necessarily change unless we break out of this downtrend. Perhaps earnings season could be the potential catalyst for that. But from my perspective, until it breaks that, the larger view here is still likely going to be bearish, at least in Q1.
Yeah, Tony, we're looking at a technical chart of the S&P 500. This is a weekly view, and of course, we have this downtrend channel drawn. I just want to reiterate that this downtrend upper channel comes in on the S&P right now, currently at around 4,000. And if on your platforms or your charting capability back home, you switch over to the daily chart and you plot the 200 simple moving average on that daily time frame, that would also actually correspond or correlate to that about 4,000 level and declining through time. So just an upper bound of where that channel is in terms of structure. So Tony, given the expectations, of course, of potential rallies, right, and names that are going into the earnings season into the end of January, I'm wondering what the trade idea is for today.
Yeah, in the spirit of kicking off a new year, I am looking at longer term investment opportunities because I am quite optimistic going to the second half of this particular year. And one particular stock, Tesla, that I've been bearish on throughout the entire year of 2022, I believe now has reached a level that I think is investable in my opinion.
You know, once a major darling, I would say, of many equity bulls out there, has certainly turned majorly sour over the past several weeks. It just feels like it's been coming down nonstop with a lot of gusto. I'm curious, Tony, what makes you want to turn bullish now? What specifically are you looking at?
Yeah, so a few different things, but traditionally, as a lot of investors are rushing to the exit right now with Tesla, as you've seen over the past few weeks, it's been just nonstop selling of this particular stock. I believe opportunities can be found during these types of panic sell-offs. If you look at the stock here, it's down over 70% from its peak from November of 2021 here. And buying here might literally feel like you're catching a falling knife here. But from my perspective, you look at the technical chart here, the stock has reached what I would consider as a fairly important support level around the 110 level. If you look back, going back to the July, August, September range of 2020, this is really one of the major breakout levels during the initial phases of the pandemic. So the fact that we pulled back all the way to this level, from my perspective, is an important level to pay attention to potentially as a buyer. But I think while charts are important from this perspective for a timing and price perspective, the foundation of my thesis here to be looking at Tesla as an investment is really based more on a valuation perspective, because that 110 level that I'm referring to, when I was trading back here in July and August of 2020, the stock was earning somewhere around 63 cents per share. Today, the stock is a very different stock. It's earning over $4 per share. So you're talking about nearly 8 times the EPS as an investor today than you were at the same level roughly 2 years ago. And if you think about this right now, this is really a story of valuation. Tesla is now trading at only 20 times forward earnings. This is, in my opinion, a valuation that's back to reality. For the past few years, this is a stock that, from a valuation perspective, has been completely decoupled from reality. So the fact that now you can buy the stock at about a 17% premium relative to where the S&P 500 is trading, yet this is a stock that's still expected to grow 36% revenue next year, 32% EPS growth next year. We're talking about orders of magnitude higher in terms of growth relative to the market, yet you're paying a valuation very similar to the rest of the markets. And this is really where I think, from a valuation perspective, it's quite compelling, in addition to the stock reaching an important level of support.
I mean, Tony, stock declined 70+%, projected to grow revenues and earnings at the rate, that's a lot higher than the S&P 500. And we're just now getting to that 20x multiple. I mean, if that's not telling you the story, right, of where it was trading in valuation terms in the months and years prior, I guess what else would, right? So what is the trade setup? I'm curious, Tony. We're here to discuss option strategies, so let's take a look.
That's exactly right. Now, with typically a long-term investment opportunity, I like to look at buying leap options. But right now, the implied volatility of Tesla options, because of the extreme sell-off we've seen here over the past few weeks, is extremely expensive. The IV percentile on Tesla options are around 71%. So for me, in order to still purchase upside here by buying a call option, from my perspective, it's too expensive. So I am going to look at a more complicated structure, but I'll try my best to break it down into pieces that we are much more familiar with trading. So the trade structure that I'm actually looking at is using a broken wing call butterfly. So I'm going out to the February 17th monthly expiration, and I'm looking at the 115, 145, 155 call butterfly. Earlier today, this was trading at about $6.80, roughly somewhere in that range. Now, just to kind of explain what this broken wing call butterfly consists of, it actually consists of a debit spread and a credit spread combined into a single strategy. So the way to think about this in more simple terms is looking at buying a 115, 145 debit spread, and what that's going to give me is upside exposure to this particular to any upside in Tesla for a limited risk exposure. And then what I'm going to do is I'm going to sell an additional 145, 155 call spread in addition to that with this debit spread. And what that's going to do is further collect in a little bit more premium that's going to reduce the cost of buying the debit spread. There is some additional risk to this because if the stock goes above that 145 strike in that debit spread, I am going to start to see some losses. But the reason I'm using a broken wing butterfly here is because if the stock exceeds significantly above that 145 level, that I'm not going to see losses to the upside. If versus a traditional butterfly, if the stock rate reaches significantly higher, I would actually start seeing losses. And the key here with a structure like this is picking that 145 strike. Where do you pick the strike price that you sell the two contracts of call options at? And from my perspective, the best use of options data is to use a 1 standard deviation move, meaning the expected move of the stock between now and the February 17th expiration date is why I've chosen that 145 strike. That is based on the current implied volatilities, how much we expect the stock to potentially move within a 1 standard deviation range. So that's kind of the trade structure that I want to use. It's a little bit more advanced. It takes a little bit more, it requires trading 4 legs, but there are some advantages that you can do by reducing the cost down to only about 6% of the stock's value. So no matter what happens, I'm risking only roughly 6% of the stock's value using this trade structure, giving me nearly a 3-to-1 payoff if the stock does land up at around that 145 price level by the February 17th expiration date.
Tony, thanks so much for breaking it down. Again, just to reiterate, I mean, broken wing butterfly might sound really complex, but as Tony broke it down for us here, is just 2 spreads stacked on top of each other. And broken wing just means that the spread widths are slightly different, right? Tony, it's probably not the best idea to try to catch falling knives in the bear market, but if you're going to be contrarian, if you're going to do something like this, if you're going to make a stance, probably doing it with options is the way to go by limiting your downside risk. Tony, I wanted to remind everybody that Tesla is reporting or is expected to report earnings after the close on January 25th. So you will be incorporating, right, that event, that binary event with the expiration selection. You've broken down the reasons for the 145 strike selection on the short side, right? Selling 2 of those. We as strategists, as traders, have really good memories when it comes to prices. I follow Tesla very closely, and I remember very clearly November 16th, 2020 was the date where S&P Global had a press release, stating the fact that Tesla was going to be included into the S&P 500 at the end of December of 2020. And what do you know? The price of Tesla was slightly under 145 on that date of November 16th, and then it went on a massive ripping rally into the low 200s prior to the day of the inclusion. So interesting strike selection. We'll see where we get to. We'll see how we do into the earnings and post earnings. Jessica, I guess it's time to bring you into the conversation. What is your first trade idea for this new year of 23?
Sure. And thank you, KV. Well, we're in the midst of an elongated period as we await the Fed's next interest rate decision, which is February 1st. So I'm turning my attention again to economic data just to get a gauge of that and understand the labor market. Now, something we've been talking about consistently is the labor market shortage. There are too many job openings and not enough workers to fill those jobs. And as I said before, the Fed cannot print people. However, potential solutions to that labor shortage is driving automation and efficiencies within the labor market.
Jessica, as Tony mentioned, we are getting an employment situation report tomorrow morning, pre-market open Eastern Standard Time, and we're going to get a CPI report, an inflation report actually on Thursday of next week. So both are coming, I guess, before the next FOMC announcement on February 1st. So I'm curious, what are your thoughts? What are you looking at in terms of securities that might be of interest to you?
Yeah, that they are. And even today's data gave indication and reiterated that red hot labor market. So as we're preparing for earnings season, as Tony said, I also turned my attention to what was said last earnings season. And a lot of that was exactly that thesis, which is automation. CEOs and executives gave us indication that they're spending their precious OpEx dollars within automation to drive efficiencies. Now, you've probably heard about ChatGPT. There's certainly a lot of hype around that and that AI technology. So I wanted to screen for something that had that revenue exposure. And it's something we've talked about before, which is Microsoft. So Microsoft does have a large revenue exposure to similar technology that fuels ChatGPT. And I'm hoping that will translate into earnings, and that will certainly take some time. Now, yesterday, Microsoft did drop 5% due to an analyst downgrade, but over the 50 analysts that cover it, above 90% of them still have a buy rating on Microsoft, which I found interesting. And of course, Microsoft is down today with the broader market. So what I need to look at from a fundamental perspective is that contraction. Microsoft is trading around 20 times next year's earnings. It's still expecting positive revenue growth and positive earnings per share growth, 13% and 17%. So that gives me an idea of the valuation. And I still think it's going to play out well utilizing that thesis of automation and the revenue exposure that it has. But again, a long-term view. Now, from a technical perspective, Microsoft is coming near and tested today that 200 moving average at 220. So that's something I have my eye on. It tested that and held true previously. So I want to position my trade, take into account that 220 level.
Jessica, I'm sensing a theme here. It seems like OptionsPlay is going bottom fishing. So both of you are thinking bullish strategies, being a little bit contrarian, looking for potential areas of support. We're looking at a weekly Microsoft chart, right, with that 200-week moving average plotted on there. It was tested earlier in the day today, was tested for the first time in a very long time, in November of 22, at the beginning of November. And so, you were obviously expecting it to hold and potentially to see a bounce off of that level going forward. What's the trade setup for this potential bounce?
Yeah, absolutely. And then the weekly moving average is so important to point out because it's a longer time frame, a smoother line, and gives us a step back, if you will, to understand those strong support levels. Now, as far as the trade is concerned, I'm structuring this a little bit differently. Normally, when we're looking to take a longer dated position within a security, we look at selling cash covered puts. That has substantial risk potential in comparison to buying the stock outright, but requires a lot of capital. So when we talked about this before, we mitigated that risk with a credit spread. I'm positioning this a little different as well. So perhaps the theme for OptionsPlay is layering on additional complexities this year. This is a horizontal or diagonal spread on Microsoft. So what I'm doing is this is a deeper in the money option. And the idea of that deeper in the money option on my long leg, the 210 expiring on March 17th, is giving a stock replacement utilizing options. So it's deeper in the money. That mitigates my extrinsic value. It's still there, which means I technically have less exposure as far as the capital that I'm spending, but we still have additional risk because now instead of the security, I've added the complexities of an expiration date. So there's still extrinsic value, but I mitigate it by going deeper in the money. Now I want to have upwards potential. So we are selling a shorter dated option, February 17th at 250, which is where I feel that upward momentum is going to go for Microsoft. And that's costing us about $20.90. Now, these are different expirations, so this has to be managed accordingly and something to take into account in consideration. The idea is to continuously sell calls against this longer dated options, similar to a covered call, but again, different risk exposures because now we're adding on that complexity of options. But we would like to do that continuously to reduce the risk exposure as we take a longer term view on Microsoft with upwards potential at this point to 250.
Yeah, very interesting, Jessica. Obviously, as you mentioned, this type of trade will require some trade management prior to the expiration of that dated short leg. To expiration means that we're having to pay more attention. We're having to handhold this strategy a little bit more than we normally would. We are obviously looking for Microsoft to be reporting earnings as well, right? And this anticipation of the earnings announcement that's coming up is being reflected in option premiums as well. So when you're structuring something like this, what I was noticing when I was evaluating the strategy is that the shorter dated volatility in February is actually, especially at the money, right, is certainly more expensive or higher than the longer dated vol. And it seems like you're trying to take advantage of that. You broke down the fact that the in-the-money 210 call that you're buying has both of those components, the intrinsic value and extrinsic value. Intrinsically, right, it's worth the difference between the price of where Microsoft is right now and the strike. So it's got, approximately, based on the slide, about $17 plus of intrinsic value. The remainder of that, $23.50, right, is the difference of what the extrinsic value or time value component is. And that's what you're trying to overcome by the end of the March expiration eventually. So, guys, you both presented a limited risk, limited reward strategies today. Being contrarian, you're looking for short-term bounces and mega caps into earnings. That's great. You're not exposing yourself to tremendous amount of risk to the downside because you're limiting your maximum potential losses to the initial debits that you're paying for these strategies. I assume that we have a look back that we need to take a look at, given the fact that there is a strategy that needs a little bit of management, right?
Absolutely. So this is a trade we did last year when technology reached its 200 daily moving average. And that's XLK. We're utilizing the ETF as a proxy for the technology index. That 200-day moving average was around 135, which is where we structured this bear put spread that you see on the screen. Now, we didn't have a show the last week of December, but realistically, we have best practices when trading any type of option. And unfortunately, we can't do look backs on every single trade, but it's important to know that there are best practices that we apply on the exit strategy, both on the profit side and of course on the loss side. This one is definitely on the profit side. Realistically, we would have closed this last year when XLK reached that lower level of 122. And we're looking, of course, to close that and take risk off the table. And additionally, so we have the prices we have on the screen is going to be the gain of 450 if it was closed based on prices that were captured earlier today. But more importantly, as we've been talking about this ramp up into earnings, with a ramp up into earnings, especially on the technology side, as we shift into that also is going to have an increase in implied volatility, and an increase in implied volatility is going to make these options premium going up, which reiterates that we need to take this trade-off, go ahead and capitalize on the profit, so that way we don't expose ourselves to any more risk.
Yeah, expecting some bounces, obviously, in these names. Naturally, if you're expecting bounces in some, maybe there'll be bounces in others. So taking off a bearish stance view at a pretty nice profit here makes a lot of sense. Well, Jessica, Tony, this brings us to a close as I am sharing these disclosures, the disclosure slides. I would definitely want to thank you for fresh and new ideas as always. We're really very much appreciated.
Absolutely. Thank you for the engaging conversation, Constantine.
Thank you so much for having us, KV.
Absolutely. Listen, everyone in the audience, obviously we've discussed some more complex strategies here today. We on the strategy desk run specific follow-up sessions to these presentations the day after it airs live. I think it would be also important, I guess, to attend tomorrow's if you have questions, if you want to learn more about how to utilize Fidelity tools and resources and find some additional Q&A and commentary around how these structures work. Please join us in the money follow-up tomorrow by going to fidelity.com/in the money follow-up. And for further investing insights, please sign up for the Fidelity Active Investor newsletter that comes out fresh very frequently. Fidelity.com/active investor weekly. We'll see you back here again next week. I will be back again with Jessica and Tony next week. We'll see you soon. Take care, everybody.